Hey guys, it's Sasha. Warren Buffett has been selling stocks at the fastest rate in history. In the most recent quarter, Warren Buffett's investment company Berkshire Hathaway sold even more Apple stock. At the end of 2021, Berkshire Hathaway had over 907 million Apple shares, which would be worth around $213 billion today. But in this most recent report, Berkshire Hathaway says that they only had less than $70 billion of Apple stock remaining, which means they have now sold about 2/3 of their Apple position in the last 2 years. The value of some of Warren Buffett's other investments have increased this year. American Express is up 62% year to date, and Bank of America is up 41%. But Warren Buffett is not redeploying the cash from selling his Apple stock into those positions. In fact, Berkshire Hathaway have not been buying any other stocks either and are now sitting on $325 billion worth of cash. That's roughly equal to the amount of cash held by Nvidia, Microsoft, Apple, and Amazon put together. The Financial Times have printed this chart that shows exactly how quickly this giant pile of cash has grown as Warren Buffett has been selling his Apple shares. You can see that he built up a small pile of cash before the dot-com crash hit, and then he built up almost $50 billion worth before the financial crash in 2008. And then again, he built up almost $150 billion before the market downturn in 2022. But Berkshire Hathaway has never seen an increase in their cash position like what we have been seeing in the last 2 years, certainly not at this rate. So the question is Warren Buffett predicting a stock market crash? Because that's what all the media is going with. And I don't think he is. I think it's actually a lot more interesting than that, because Warren Buffett is not sitting there trying to time the market. Warren Buffett is one of the greatest investors that has ever lived. And you know what? You can invest just like Warren Buffett if you use eTORO, who are the sponsors of today's video, because eTORO has a unique feature called Smart Portfolios, which copy the stock picks of famous investors or let you invest in portfolios based on themes. So you can invest in the same stocks that Warren Buffett invests in if you want to, or you can copy Nancy Pelosi, who has become a bit famous for beating the market by mysteriously buying stocks just before those exact stocks go on a big run. If you are a big believer in big tech, you can invest in the Magnificent Seven, which is literally a custom portfolio just made up of the big 7 tech stocks. Or you can choose to copy Bill Gates or Carl Icahn. There's over 100 different options. eToro is one of the most popular investing apps in the world, and Smart Portfolios are just one of the many unique features that make eToro stand out from the crowd of other investing apps that all look the same and work the same. Go and try eToro out. Use the link in the video description or in the pinned comment. So why is Warren Buffett selling stocks? Well, I actually found myself in a very similar situation recently. I just sold some airline stocks that I held in my portfolio. I owned United Airlines and Delta Airlines, and United went up over 100% in the last few months. Delta went up over 50%, and I sold both of those stocks because they hit my price target. And I have now found myself in a very unfamiliar place, a place I've not been before. My portfolio is now 18% cash, and I have never sat on this much cash. But I think the reason why I am now sitting on cash might just be the same reason why Warren Buffett is sitting on cash. And that reason is that every single stock that I look at the moment, every single sector that I go and look at, looks overvalued. In the year and a half from January 2023 to summer 2024, AI stocks went up like nothing ever has gone up, while other stocks did nothing. We saw Nvidia explode, all the auxiliary companies explode, Google, etc. All of those companies went absolutely bananas. Everything that had anything to do with AI saw hundreds and hundreds of percent gains, went straight to the stratosphere, but there were still good investing opportunities in other spaces where you could still get good value. I thought airlines, for example, were undervalued, and that's why I got a position in airlines. And those have gone up in a vertical line since the summer. Banks and financial companies have also gone up in a vertical line since the summer. Walmart has gone up absolutely ballistic this year, up 74% year to date, and now sitting on a PE ratio of almost 50. Costco is exactly the same, up 50% this year and a PE ratio of 60. Retailers are killing it. Farm and industrial machinery companies are up a lot. Caterpillar is up 40% this year and sitting at all all-time high share price. Same goes for Deere & Co. Insurance companies are sitting at all-time highs, up massively last couple of years. Oil companies are sitting near all-time highs, and oil price has been abnormally high in these last couple of years. Literally everywhere that you look, valuations are going crazy. And in the last 6 months, multiple different sectors that are not AI have themselves exploded and gone through the roof. It's almost impossible to not have made money in the stock market this year, almost irrelevant what it is that you picked. The S&P 500 is up 27% so far this year on average, after getting a 24% return last year. Even Cathie Wood and Meet Kevin have managed to not lose money this year and made a third of the return of the S&P 500. If you look at the Shiller PE ratio, it is now sitting at 38.29 as I'm recording this video, after going up in the vertical line in the last 2 years. It was going up fast last year, very fast, but that vertical line has just become even more vertical in the last few months since the summer. Now, in the long run, the Shiller PE ratio is maybe not the best tool to decide if the market is overvalued or not. It's a bit simplistic. It doesn't account for different trends in how the market becomes more global over time, how people place more value on long-term returns, etc. But what you can see from this chart is the level of market exuberance, the crazy level of market exuberance. When this chart goes up in a vertical line, it means the market is absolutely losing its marbles and valuations of companies are going up so insanely fast because of the hype. You can see that the other times when the market went absolutely bananas, and this chart went up in a vertical line, was the late 1920s, just before the biggest stock market crash in history and the Great Depression that followed. Then it went up again in a vertical line in the late 1990s, the biggest stock market bull run in history, just before the dot-com crash. And then it went up in a vertical line in 2021 when everyone was busy buying Peloton stock and Zoom stock. It all almost looks kind of funny now in retrospect, right? When you look at what people were talking about back then, and how a company that makes very expensive coat hangers went up 725% in a few months when the pandemic started, and is now down over 70% from its pre-pandemic share price. Because when a crazy bull run happens and valuations of companies go bananas through the roof, very few people take a step back and ask, is this okay? Or is this just stupid? Everyone begins hyping these stocks. Everyone is a genius in a bull market. Reddit and Twitter finance communities go into overdrive. Everyone is winning. Stocks go up 800% in a few months, and everyone starts buying them after they've gone up 800% because the PE ratio of 330 is cheap. And if you don't think so, if you disagree, then I'm sorry, you are a dinosaur and you don't understand anything. You don't understand AI, bro. It's the future, bro. Perhaps Warren Buffett is looking at stocks and seeing the same exact problem. What exactly do you go and invest into? Everything around is just so expensive. The euphoria of the stock market from 2020 and 2021 is back and then some. Nvidia is selling graphics cards at 5 times the price because of the AI hype wave and a long queue of tech companies wanting to buy those graphics cards. And the stock market is valuing Nvidia today as though this recent insane growth in revenues and an even more insane growth in profits because of the higher margins will of course continue growing at the same insane rate into the future for the next decade. The market will crash. The question is when, because the market always crashes. Because you can just sit there on cash and the market could continue going up in a vertical line for another 3 or 4 years. And you sitting there on cash, you'll just miss everything. That happened in the 20s, it happened in the 90s, it can happen again. We can have 5 years or 6 years of the market just going up and up and up. And if you sit it out, waiting for the inevitable crash, you could miss out on the huge gains. It is possible. But people like Warren Buffett do not suffer from FOMO. He is not in it to try and speculate or gamble or try to time something perfectly. That's not what he's doing. In fact, Warren Buffett just posted a letter talking about giving away all of his wealth to charitable foundations, and he encouraged people to talk through their wills with their children so that their children can understand the reasons behind the decisions in the will and have the opportunity to ask questions. And you know what? This is a very good point, because if you don't discuss your will with your children before you die, by the time they read it, if they do have questions, it will be a bit too late to ask them. So intentionally timing the market is a bad idea. We all know that. We all see fund managers and YouTubers do it over and over and fail at timing the market over and over again. But if you own stocks, and those stocks have run up to what you think is now fair value, maybe they've gone a bit over what you think is fair value, sitting at record highs, and your valuation model just says there is no more upside. The stock is now too expensive compared to what you think the fair value is. What are you meant to do? Well, the correct answer technically is you should probably sell out of the stock, because you should not be investing in a company if you think that company is currently overvalued. But if you sell the stock, and then you look at all the other stocks around and you don't see any good opportunities, what do you do then? Well, then you're sitting on cash, exactly the situation that Warren Buffett is finding himself in. And it may well have nothing at all with you predicting the next stock market crash. It can just be a byproduct of the same strategy being deployed, where you only invest in companies that you think are undervalued based on your analysis. And if you keep doing your analysis and not finding the undervalued companies, well, then maybe you're not going to be reinvesting the cash. By the way, if you want to learn how to do stock analysis, all the maths of it, how to read financial statements, everything in between, go and check out my course, The Investor Playbook. It's on sale for 3 more days until midnight on Monday. Use the code BLACKFRIDAY24 at the checkout to get 10% off. But from the way Warren Buffett talks about stocks, I don't think he is predicting a stock market crash. I think what's actually happening is that Warren Buffett stops buying stocks when they become overvalued. And the thing with Buffett is that he's a shrewd guy. He does not run around hyping up stocks because they've just gone up in a vertical line. He does not celebrate repeatedly on Twitter and pat himself on the back because his stocks have gone up. Instead, he just sells the stocks, collects the cash, and sits around waiting for the next opportunity. And if the next opportunity is not there immediately, he is very happy to just keep sitting on the cash until there is an opportunity. Interest rates are still pretty high, so you can get close to a 5% return on your cash by just parking it in treasuries. Look at how long Buffett sat on cash between 2004 and 2008 before he began reinvesting when the stock market eventually crashed. Then look how his cash position kept on growing for years before he bought some stocks on the cheap in 2022. But even then, he didn't deploy all of his money, and Warren Buffett is very happy to sit there and wait 2 years, 4 years, 10 years, however long it takes, because he knows that the stock market is fickle. Today, everything can be overpriced, and it can be overpriced for a long time. And tomorrow, the stock market can have a hissy fit, and you're going to be shopping in the discount aisle, buying the same stocks at 70% discount. Most investors don't think like this, which is why most investors end up losing to the stock market average over time. Most investors are jumping on all the big popular bandwagons right now because people are blinded by past performance. People look at the graph going up in the vertical line, and they just can't miss out on the vertical line continuing going up in the vertical line. And maybe they will be rewarded by another 2 or 3 years of the insane stock market growth. Good if that happens. But then again, the 2022 dip was short-lived, and the 2020 dip reverted back pretty much immediately. We have not had a real serious, prolonged and painful stock market crash since 2008, and it's been 16 years, and that is quite abnormal. We're overdue. So maybe, just maybe, Warren Buffett is onto something. Remember to go and check out my sponsor eTORO, link in the description and the pinned comment. Thank you so much for watching, and I'll see you later.